Hello and welcome to the Road to Retiring YouTube channel. Today I am looking at Microsoft. The first thing I like to look at for a stock is its moat. A company's moat refers to its ability to maintain the competitive advantages. I consider a company to have a wide moat if they have an average compound annual growth rate of over 10% over the past 7 years in the following metrics. 1. Equity growth. 2. Earnings per share growth. 3. Operational cash flow growth. 4. Revenue growth. For Microsoft, for equity growth this is 7%, for EPS growth, 26%, for operational cash flow growth, 15% and for revenue growth, 10%. This is an average compound annual growth rate of 15% across the 4 metrics, nicely above the 10% benchmark I look for. I also like to see that the management are investing funds efficiently before I decide to purchase a stock, and I consider a return on invested capital of over 10% to be a good signal for this. Microsoft's ROIC is currently 28% and has been consistently well above the 10% benchmark over recent years. Additionally to this, I want to see that any long-term debt the management is taking on can be paid off. To measure this, I want a company's free cash flow to be able to pay off long-term debt within 3 years. Microsoft has $71 billion in long-term debt and $60 billion in free cash flow over the trailing 12 months, so I am confident Microsoft will not be in imminent financial trouble because of this. Microsoft performs well across all these metrics, so I will set the margin of safety at a low 10%. Now we have analyzed these metrics, it is time to consider what price I would buy Microsoft under. To do this, I estimate the value in 2028 and then calculate what value the stock needs to be now to achieve a 9.5% compound annual growth rate to that estimated value in 2028. However, as Microsoft has a 1.05% dividend yield, I am going to reduce this discount rate to 8.45%. I estimate this value in 2028 in 3 different ways, using the price over earnings multiple, the price over sales multiple and the price over operating cash flow multiple. The average of these 3 predictions brings a 2028 value of $376, so the average buy value when looking for a 9.5% compound annual growth rate and applying a 10% margin of safety is $225.64, so I would buy Microsoft if it fell under this price. This 2028 value of $376 was calculated based on the following estimates: an earnings growth rate of 9%, share dilution of -0.8%, revenue growth rate of 14% and an operating cash flow growth rate of 10%. With the following multiples, P/E of 25, P/S of 6.5 and AP/OCF of 20. Comment below with any other stocks you want me to look at and suggest different estimates for these values, and I can tell you how this will impact the buy value.